Big rally on Wall Street at this hour. Check it out.
A historic day for the market.
The pandemic-era stock market was filled with massive rallies.
Nothing seems to get in the way of the stock market going higher for very long.
And that drove a horde of investors to buy in, hoping to make big money.
A record number of new and novice retail investors jumped into the stock market over the past 2 years. They were trying to figure out as they went, and many of them dabbled into some of the riskier trading strategies.
One of those risky strategies is called options trading. An option is a contract to buy or sell an asset at a future date for a set price. Options activity hit a record high in 2021 with nearly 9.9 billion contracts traded. That was more than 32% higher than the previous record set in 2020.
Options are the kinds of bets where you can lose everything.
You're on social media seeing more and more people talking about these amazing gains that they've gotten. It's not as easy as social media makes it sound.
The appeal for a lot of the retail investors to buy options is that they're much cheaper. But your potential for profit is actually not that high.
Everything that you can trade, options, futures, whatever, they in of themselves are not bad tools. Fire is a wonderful tool. If you don't know how to use it, it's going to end poorly.
So what we've seen with the rise of certain fintech apps, like for example, Robinhood, it's become increasingly easy for individuals to trade options. It's actually a fairly unregulated area. That's part of the problem.
So why did options activity increase so rapidly in the past year? And what makes trading options so risky?
The whole meme stock phenomenon partly triggered the boom in options trading among retail investors. We're talking about stocks like GameStop and AMC that were popularized on social media by retail investors trying to coordinate trades and squeeze out hedge funds and other short sellers.
One trend that we've been seeing in options over the last year or two is a real focus on the near term options, 1 to 2 weeks out. That's where we're seeing a higher percentage of the overall volume.
Individuals have often taken to social media to report their gains and profits from highly successful options bets. And that's made it very attractive for first-time traders and those who are maybe have invested in more traditional, conventional ways in the past and are now interested in trying something new.
Technology has made trading options much more accessible.
Options have become increasingly popular among individual investors using platforms like Robinhood because they can often yield profits at many more multiples of one's initial investment. Where you might only be making 5 or 10% on your capital when you buy stock. With an option, you can make many, many times your initial investment.
Think back to 10 years ago or 20 years ago. If you wanted to trade an option, you needed to, maybe call up a broker on the phone. You needed to pay a significantly high amount of commission. You didn't see the markets real time. There's much easier access to options markets. And the use of options has pretty much just grown alongside of that.
What some of these apps have done is made it a lot more visual to understand what your profits and maybe even losses are going to be. So that's led to an increased interest in trading options. There's also a sort of addictive component to trading with highly speculative instruments like options. When you make a lot of money, maybe you just get lucky and you make a lot of money, you're inclined to do it again. This is in many ways like casino gambling.
People say take the emotion out of trading. It's very difficult to take the emotion out because it's money. People get emotional about money. What you want to do is make it as robotic as possible. So you take that out of it. How do you do that? By giving appropriate risk on your investments so that they're not eating you up inside.
Most popular trading apps generate a lot of revenue from payment for order flow, and they can make more money from options than regular stock trading. So there is an incentive for them to lure investors into options trading.
I think there's a myth that's carried over from the 1970s where firms just want to churn people up, etc. No, we don't. It's a bad use of our time. It's a bad use of your time. It's why we start everything we talk about in trading and investing with risk, risk, risk.
Options are financial instruments which give you the right to buy or sell a security. They're called a derivative because they're a kind of financial contract that's not a share of stock itself, but it's linked to or derived from a share of stock.
It's best to think of options as an insurance product, and it's an insurance product for stocks.
An options contract allows an investor to pay a fixed sum of money to lock in a set price to either buy or sell an asset. The underlying asset can be a stock, crypto, a commodity, or a whole number of other things. There are also two types of options contracts, a call and a put. A call option allows the investor to buy, say, a stock at a pre-agreed upon price. This price is called the strike price. A put option allows the investor to sell at that strike price. That means investors use a call option when they think the price of the stock is going to go up. They use a put option when they think the price is going to go down.
We always used to say, with old phones that used to sit down, you would call someone up. You'd pick up, you'd call up. And when you put it down, you put down. So the way to think about it is when you buy a call, you'd like us to go up. When you buy a put, you'd like us to go down.
Options can yield a high profit when exercised strategically, but miscalculating can come with a big downside.
One of the risks of this sort of intense options trading is that people might find themselves on the wrong side. So it's great if you buy a call option and the price goes up. You'll make a lot of money on that call option. But if you buy a call option because other people said that they bought call options and the price ends up going down, well, that's where you can lose all your money.
Most popular brokers have a tier system for options trading, and they grant access to their clients based on their income, their risk profile, and their trading experience. Most retail investors only have access to the most basic call and put options. They don't have access to option spread or other more sophisticated strategies.
Option spreads are used to bet against various market outcomes.
An option spread calls for buying and selling different contracts at the same time. It's a very common way for investors to hedge risk and volatility, and it's usually cheaper because you can offset your costs by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. In 2021, 11% of Robinhood's active users made an options trade. And of that, fewer than 1% actually made a multi-leg options trade.
Let's say a level 1 investor pays $30 to buy a simple Tesla call. The stock strike price, which is the price the investor is willing to pay for the stock in the future, is $1,000. In order for that trader to break even, the stock price has to hit at least $1,030 before the call option expires. The same goes for a level 2 investor. A level 3 investor, though, has access to a more sophisticated strategy, a bull call spread. With this strategy, the level 3 trader buys a $925 call for a cheaper premium of $27. The investor would also sell a $1,000 call at the same time. Both of the call options would have the same expiration date. This trader would break even if the stock price hits $952. This represents the bottom of their profit range. They will continue to make a profit until the stock hits $1,000, which is the strike price of the higher call option they sold. This creates a range in which the investor can make a profit. This strategy is typically used when the investor expects a modest growth in the stock's price. The level 1 investor has a 25% chance of profit, while the level 3 investor has a 40% chance.
So in the beginning, retail investors have to learn options trading by trial and error because they don't have access to those more sophisticated strategies at first. And they will only be able to hedge risk and trade more complex strategies with higher chance of profit later on when they graduate to a higher level.
I've worked on a thinkorswim platform for the last 16 years, and we're very proud of it. Our clients have more information now than most professionals did 10 years ago. That's been fairly level, that part of the playing field. The difference is what people do with the information and how people put the risk of the trade on themselves.
In June 2020, Robinhood made multiple changes to its platform after a 20-year-old customer died by suicide and cited major losses on the app trading options as one of his stressors. Those changes included making it more difficult to access Robinhood's options offerings by requiring customers to go through specific education and to meet other criteria if they are seeking level 3 options.
So we've classically had for many, many years screening criteria, which are designed to filter investors by sophistication. This is a difficult problem because whatever criteria we might invent ends up inevitably being perceived as elitist or classist in some way, that you are excluding people who may not have had a particular form of education or may not have a particular level of income. And so the goal has been to develop screening criteria which are neutral with respect to characteristics of people's background that may, unfairly discriminate. So that's been a real challenge. We don't want to lock people out of gains just to protect them from losses.
Regulators want to protect retail investors because they're aware of the risks involved in options trading. The irony is that now retail investors are less likely to make money from options because of the lack of access to more sophisticated strategies.
A Robinhood spokesperson told CNBC, democratizing finance for all means expanding access to important financial tools that were previously available only to the wealthy few. And we're proud to provide an options experience that's intuitive, educational, and affordable with no contract fees. We know options aren't for everyone. Robinhood does not allow short selling or uncovered options trading. Beyond regulating brokerages, there have also been proposals surrounding disclosure rules and social media.
We saw, for example, in the GameStop episode that certain market participants were on social media saying, I bought, hundreds of call options. I've made millions of dollars of profits. Other market participants began to mimic them. And so that's actually not illegal right now.
Roaring Kitty was one of the influential figures on Wall Street Bets subreddit. He was consistently posting screenshots of his portfolio, touting massive profits from his GameStop position. And he was buying a bunch of GameStop call options.
Roaring Kitty, whose real name is Keith Gill, testified in front of Congress in February 2021 about his intentions for disclosing his positions.
The idea that I use social media to promote GameStop stock to unwitting investors and influence the market is preposterous. My post did not cause the movement of billions of dollars into GameStop shares. It is tragic that some people lost money, and my heart goes out to them.
In February 2022, the Securities and Exchange Commission proposed a new rule that would tell investors more about short sales. It would require certain investment managers to report short sale-related information to the commission on a monthly basis. The SEC would then make the aggregate data available to the public for each individual security.
What we worry about are situations where people are saying one thing but doing something else. So you might buy a call option thinking the rest of the market is genuinely bullish on a company, but you were deceived because they were just telling you that so that they could cash out, that they could make money, take your money basically, sell while you were buying. So the situation where people are saying one thing but doing something else, that's a real problem with social media.
We wanted to get people to come to the market. We didn't think they'd all come at once. So I think that was a bit of a surprise for all of us. That said, the unheralded story is our education usage went up in direct proportion to how many new clients we had. People want to understand. We want to give them the information. Something our firm does, and I think as an industry we do well, is give people just tons of free education.
Invest in you. Ready, set, grow. CNBC and Acorns.